Wealth isn't random, it's systematically acquired. The disparity between the rich and the poor is due in part to how capital works for different economic classes. For the rich, capital is more than just money, it's a tool that multiplies itself. Most wealthy individuals leverage their capital by investing it. These investments often yield returns far greater than traditional income streams like salaries. Capital gains, dividends, and interest income are significant contributors to wealth accumulation. Another factor is access to better financial advice and opportunities. The wealthy can afford top-tier advice, enhancing the growth of their investments. They often have exclusive access to lucrative opportunities unavailable to the average person. For the average person, most income comes from labor, not capital. This limits their ability to invest and grow wealth over time. Without substantial capital to invest, it's challenging to achieve significant wealth growth. This cycle perpetuates wealth inequality as the rich continue to invest and amass more capital. Policies and market dynamics also play a role, often favoring capital accumulation over wage growth. Understanding these mechanics is key to comprehending why the rich keep getting richer. Capital is fundamental to wealth. It includes what we own and can use to generate more wealth. Real estate, stocks, and businesses are common forms of capital for the wealthy. These assets appreciate over time, boosting net worth without active labor. Reinvesting profits is a critical tactic for growing wealth. Compounding interest on financial assets accelerates capital growth. Unlike wages, which are taxed heavily, capital gains often enjoy lower tax rates, enhancing their profitability. High net worth individuals use these mechanisms to grow wealth exponentially. They strategically select investments with high potential returns. Diversification across different asset classes also helps in risk management. This ensures that even if one investment falters, the overall portfolio remains strong. For ordinary earners, accessing and effectively managing capital is more challenging. Without significant initial assets, achieving large-scale wealth growth remains difficult. This illustrates the widening gap between different economic classes, driven by how effectively they can use and grow their capital. The journey to wealth is fraught with obstacles for many. Income inequality isn't just about money, it's about opportunity access. Limited funds mean fewer opportunities to invest in high-return areas. The average person often relies heavily on earned income, unlike the affluent who rely on investment income. Education on financial literacy may be lacking, further compounding the challenge. Without knowledge of investment strategies, it's difficult to make informed decisions about wealth growth. Furthermore, the lack of financial networks that provide insider advice is a disadvantage. These barriers prevent the accumulation of capital that could be used for wealth building. Inequities in the financial system can also perpetuate these differences. Credit systems may offer unfavorable terms to those with lower incomes. High interest rates and fees can erode already limited financial reserves. Consequently, these barriers create a cycle that is difficult to break, maintaining the status quo where the rich grow richer and the average person struggles to keep pace. Addressing the wealth gap requires both systemic changes and individual strategies. Improving access to financial education could empower more people to make better financial decisions. Understanding investment basics can help individuals start growing their capital, however small. There's growing discussion about policy changes to address income inequality. Proposals include altering tax structures to favor income from work rather than capital alone. Increasing access to capital markets for everyday individuals can level the playing field. This can involve offering more affordable investment options to the broader public. Encouraging savings and prudent financial planning from an early age can also make a difference. Building a diverse portfolio, even if modest, can lead to steady wealth accumulation over time. Small, consistent investments can exploit the power of compounding interest. Encouraging a culture of saving and investment is key. Together, these steps could help bridge the gap, allowing more people to share in economic growth and ensure that prosperity is more evenly distributed.